If you've been watching the stock market lately, well, you know AI is absolutely the talk of the
Ah,
town.
completely. It's everywhere.
Yeah, I mean, companies like Nvidia, their stock price has just exploded more than tenfold since late 2022, now commanding a staggering, what, $4 trillion market cap?
It's incredible. Truly incredible numbers.
It naturally makes you wonder, doesn't it? Have we completely missed the boat on this whole AI revolution? Or, are there still massive long-term opportunities out there for investors?
That's the million-dollar question, or maybe the trillion-dollar question now.
Huh, right. Well, today we're taking a deep dive into an article that tackles this. It's titled Three No-Brainer Artificial Intelligence AI Stocks to Buy Now and Hold Forever. Came out on The Motley Fool just yesterday, August 8th, 2025, by Adam Levy.
Okay. And our mission here really is to help you understand why this particular article isn't just picking companies using AI. It's focused on something deeper. It's looking for companies with what it calls durable competitive advantages, and crucially, ones that are still considered great values even after strong results. We really wanted to dig into what makes these specific companies stand out for the long haul in AI.
Right, so it's not just about the AI hype, but the underlying strength. Okay, let's start with that core idea then. The article's central argument, it sounds pretty compelling, that the biggest enduring winners from AI won't be these sort of flash-in-the-pan stocks.
Exactly. Not the ones that just grab headlines for a bit.
Instead, it argues the real long-term champions will be companies with truly sustainable long-term competitive advantages. But, like, what kind of advantages are we actually talking about here?
Yeah, that's a critical distinction, isn't it?
Hmm.
The article isn't just looking for companies, adopting AI. It's looking for those embedding AI so deeply into their core business that it creates these defensible moats.
Moats. Okay.
Yeah.
Like making them harder to compete with.
Precisely. It could be through, say, vast amounts of proprietary data they have, or maybe incredible customer integration, that stickiness factor, or even unique infrastructure that's just really hard to replicate. It's about how AI fundamentally makes their existing strengths stronger.
Oh, okay. I see.
And importantly, for anyone feeling like maybe they've missed the big AI run-up, this perspective offers some reassurance. It suggests it's absolutely not too late to find attractive AI stocks if you focus on these kinds of inherent strengths.
Got it. Building fundamental moats with AI. All right, let's unpack the first company on the list then, Amazon. AMZN, most people know Amazon, of course, home to the biggest public cloud platform, AWS.
Amazon Web Services, yeah. The scale is just, well, it's huge.
Huge is an understatement. The article says AWS generated $116.4 billion over the last 12 months. That's roughly 50% larger than Microsoft Azure, the next competitor.
Yeah, massive scale.
But I seem to remember some chatter maybe last year about AWS being caught flat-footed a bit when generative AI first really took off. Did the article mention that?
It did, yeah. That's a fair point. When generative AI first burst onto the scene, AWS was maybe a little slower off the mark compared to some others, and they did cede a bit of market share initially.
Okay.
However, the article points out they initiated a pretty rapid course correction. They launched their Bedrock platform.
Bedrock. What's that exactly?
Think of Bedrock as like a managed service. It makes it easier for developers to grab various foundation AI models, including Amazon's own, and build and scale generative AI applications on AWS. And that platform is now seeing triple-digit growth.
Wow, triple digits.
Yeah, in its AI services.
Wow.
So that's allowed AWS to pretty much maintain most of its market share, even in this really fast-growing market. They caught up quickly.
Okay, that makes sense. What about margins? I thought there was some concern there too.
Ah, right. There was a temporary dip in AWS's operating margin in the second quarter. But the article clarifies, and management did too, that half of that decline was actually just due to the timing of stock-based compensation.
So accounting stuff, not core business weakness.
Exactly. How and when they account for employee stock grants. Not really a red flag for the underlying business. And the other half, that came from significant investments in capacity.
Meaning they're spending money to grow.
Right. They're spending big because demand is huge. They're actually capacity constrained, the article notes,
Yeah.
which, is a good problem to have. It means demand is possibly outstripping their current supply.
So they need to build more data centers, more servers.
Precisely. So you should expect margins to improve over time as that investment pays off. And it's worth remembering, AWS still commands higher margins than its smaller competitors. This spending is all about reinforcing that infrastructure moat.
Oh, okay. And it's not just AWS either, right? The
Mhm.
rest of Amazon's business.
No, exactly. If you look beyond AWS, the article points out that retail margins are actually improving quarter after quarter. That's partly thanks to a really strong advertising business, which itself is heavily using AI.
Ah, interesting connection.
And also, their international segment is finally starting to become a meaningful contributor to operating income. That's after years of heavy investment.
Okay, so the broader picture looks solid. Now, the stock, it did pull back after Q2 earnings, didn't it? Something about the outlook.
It did, yeah. The outlook was maybe a little lighter than some expected, which caused a dip. But the article's take is that this pullback in price is actually an opportunity for long-term investors.
Especially given that AWS potential we just talked about.
Exactly. Given AWS's strong long-term potential in really cementing that cloud leadership position, at the time the article was published, Amazon was trading around $222.61 with a market cap around $2.4 trillion.
Okay, so for Amazon, it's AI bolstering that massive cloud infrastructure moat.
Hmm.
Makes sense. But what about a company that's less about raw infrastructure and more about, say, enterprise software, customer relationships?
Good transition.
Yeah. The next one is Salesforce, CRM, very different space. How are they using AI to build their durable advantage?
Yeah, it's a great contrast. Salesforce's moat is much more about that deep software integration and, crucially, data lock-in. The real standout for Salesforce in the AI realm is definitely its data cloud offering.
Data cloud. Tell me more.
So think of it as creating a single source of truth for a company. It pulls together all the company's scattered data from sales, service, marketing, you name it, onto one platform. The goal is to create actionable insights from that unified data.
And that's growing.
Oh, incredibly. The article highlights that recurring revenue for Data Cloud hit $1 billion in the most recent quarter. That's up 120% year over year.
Wow, 120%.
Yeah, and get this, 60 of its top 100 deals now include Data Cloud, so it's becoming really central to their biggest customers.
And building on that data cloud foundation, there's this new thing, Agentforce.
Right. Agentforce is a newer product built directly on Data Cloud. It lets businesses essentially build AI agents.
AI agents, like bots.
Sort of, yeah. AI agents that can execute tasks, maybe handle customer service interactions, often with minimal human intervention. But the key here, and this is why Data Cloud is so vital, is that for these agents to actually work well, they need access to pertinent data.
Which Data Cloud provides.
Exactly. It brings all that relevant customer data right to the agent's fingertips, so to speak. And it's fascinating. They're really empowering businesses to automate in new ways.
And Agentforce itself, is it gaining traction?
It's really taken off. Launched last fall, I think.
Exactly.
The article says it's already closed 8,000 deals, representing $100 million in revenue. That makes it Salesforce's fastest growing product ever.
Fastest ever. Okay.
Yeah. And what's really interesting here is how Salesforce's existing, entrenched software suite puts them in a prime position. Companies already run so much of their business on Salesforce.
Right. They're already deep in the ecosystem.
Exactly. So adding things like Data Cloud and Agentforce just deepens that relationship. It significantly increases the switching costs. If your data is unified in Data Cloud and you've built custom AI agents with Agentforce, moving to a competitor becomes incredibly difficult and expensive.
That's the moat right there. Ecosystem lock-in powered by data and AI.
You got it. That's the competitive advantage. And the article also mentions valuation, saying shares were trading for just 22 times forward earnings estimates.
22 times forward PE for a company growing like that with that kind of lock-in.
Seems quite reasonable, right?
Yeah.
Especially in the tech space. At the time of publication, Salesforce was around 240.18 cents, market cap about $230 billion.
Okay, so Amazon's leveraging infrastructure. Salesforce is deepening data and ecosystem integration. Now let's talk Meta platforms. Meta. The article suggests they might be the biggest investor in AI globally, spending something like $66 to $72 billion on capital expenditures.
Yeah, the spending is enormous. And what's really unique, as the article points out, is that unlike Amazon or Microsoft, who build cloud capacity for others too, Meta is only building compute power for itself.
Just for their own use. That's a massive internal investment. Why pour so much into AI just for themselves?
Well, that's the key question, isn't it? The article's thesis is that Meta could be the biggest beneficiary of all generative AI has to offer, particularly in its core areas: advertising and user engagement.
Okay, so they see a massive internal ROI potential. Are we seeing results already?
We are, yeah. The article gives some Q2 examples. Ad prices climbed 9% year over year, and the number of ad impressions grew 11%. And it explicitly states that a significant portion of that improvement came directly from Meta's AI recommendation model.
So the AI is making ads more relevant and effective.
Seems like it. And it's not just ads. Time spent on Facebook and Instagram increased 5% and 6% respectively. The article attributes that to their bigger AI models driving more engaging content feeds. So the investment is refining their core product and how they make money building that ad tech moat, essentially.
Makes sense. And looking ahead, what's next for Meta's AI?
Well, their generative AI tools for advertisers, for creating ad content, those are apparently seeing strong adoption. Mark Zuckerberg noted that a meaningful percentage of ad revenue is already coming from campaigns that use these AI creative features.
Wow. So AI is actually helping create the ads now.
Yeah, and the long-term goal mentioned is even more ambitious. An AI agent that can develop and test ad creatives autonomously. Imagine that AI running the whole ad creation and testing process. Could be a huge deal for advertisers.
A game changer, potentially. What about outside of ads? Chatbots.
Right. The article mentions Meta's AI chatbot, which apparently now boasts over 1 billion users.
Oh.
That creates a whole additional channel for monetization down the line. Those probably early days for that.
1 billion users? That's another massive asset.
Absolutely. And they've also recently started introducing ads in WhatsApp and Threads. That should provide additional ad revenue, especially as generative AI potentially makes creating effective ads easier across all of these platforms.
Yeah.
It's about expanding revenue streams and leveraging that huge user base.
Okay. And financially, how's Meta looking?
Pretty strong, according to the article. Revenue climbed 22% last quarter, operating income up 38%. Impressive growth.
But all that spending must have an impact somewhere. Depreciation?
It does, yeah. The article acknowledges the growing depreciation expense, basically, the accounting cost of all that AI hardware hitting the books over time. That will weigh on reported earnings.
But the argument is...
The argument is that it's easily digestible given how fast the top line of revenue is growing, and the valuation looks attractive too. Enterprise value around 16 times forward EBITDA estimates.
Okay, EBITDA. Earnings before interest, taxes, depreciation, amortization,
Okay.
a measure of cash flow.
Right. And a more traditional forward PE valuation was around 27 times multiple. Again, both looking at expected future earnings, and those multiples seem pretty reasonable for Meta's scale and growth profile. At the time, Meta was trading around $769.30, with a market cap nearing $1.9 trillion.
Okay, so just to recap our deep dive here, the theme across Amazon, Salesforce, and Meta seems really clear.
Yeah, it comes through strongly.
It's about the enduring strength of these companies, right?
Yeah.
Stemming from how they're deeply integrating AI, but integrating it into their core, their long-standing competitive advantages.
Exactly. It's not just bolting AI on.
Right. It's AI fundamentally strengthening their existing business moats, whether that's Amazon's infrastructure, Salesforce's data and ecosystem lock-in, or Meta's ad technology and user base. That's what the article argues positions them for sustained long-term growth in this AI era.
Which, raises a really important question for you, the listener, to think about. Beyond just finding companies that use AI, how do you actually evaluate which companies are truly building these AI-powered moats? Moats around their businesses that could lead to those compounding returns, for decades to come.
That's a great point.
It's about looking past the immediate hype to see that underlying sustainable competitive advantage being amplified by AI.
Absolutely. Well, hopefully these insights give you some food for thought as you navigate the AI investment landscape. Thinking about how to spot companies that aren't just riding a trend, but are genuinely transforming their value proposition through the power of artificial intelligence for the long run.